Picture this. You are on your trading setup, price candles whip up and down like a heartbeat. You click place order and wait. A spinning wheel, a small delay. In markets, a second can feel like a fall. By the time your trade lands, the moment you were aiming for is gone. If you've traded long enough, on-chain or off, you know this feeling. You also know the other one, hidden costs. Gas fees that turn small wins into losses. Slippage that bites. Decentralized that still depends on someone else's server. We all came to crypto for a fairer game, open, fast, and in our control. But most days it still feels like we're choosing between speed and trust. That's the problem Hyperliquid is trying to solve. Think of Hyperliquid like a purpose-built racetrack for on-chain finance. Not a borrowed road with potholes and traffic, its own track designed from the ground up for one thing. Trading that feels instant, transparent, and still fully on-chain. No middle ground. No excuses. How? It starts with the foundation, a custom layer 1 blockchain, not a patch on top of something else. Their chain is tuned for low latency and high throughput, so your order isn't fighting 1,000 unrelated transactions just to be seen. On top of that sits HyperBFT, its own consensus built for quick finality. Not maybe in a few blocks. You place an order, the chain agrees, and you move on. Done. Then there's the part most traders care about but rarely get on-chain. A real, fully on-chain order book. Not a spreadsheet running somewhere in the background. Every order, every cancel, every fill. Recorded on the ledger in the open. That's transparency you can audit. That's fairness you can feel. And they push on costs, too. Perpetuals with zero gas at the point of trade. Maker rebates and low taker fees that don't punish you for being active. Tools that pros expect. TWAP, scale orders, one-click flows, without burying new users in jargon. It tries to be fast without feeling fragile and powerful without feeling complicated. But the piece that matters most isn't any single feature, it's the idea. You shouldn't have to choose between speed and sovereignty. You shouldn't have to give up custody to get execution. You shouldn't need a back channel to place a fair trade. If the future of finance is truly open, it has to be usable, not just for whales and HFT shops, but for anyone willing to learn. This video is about that promise and the system behind it. We'll keep the language simple. We'll keep the focus practical. What is Hyperliquid really? How does it work under the hood? What makes it different from other perp DEXs? Where are the risks? And if you're new, what would it feel like to actually bridge, place a trade, manage a position, and get out with clarity? No hype, no shortcuts. Just a clear look at a chain built for traders and what that could mean for the rest of DeFi. Because trading shouldn't be a leap of faith, it should be a click, a confirmation, and a fair shot. Hyperliquid is a blockchain built for trading. Not an app on someone else's chain. Its own layer 1, like owning the whole highway, not just renting a lane. That matters because when you control the road, you can make it fast, smooth, and fair for everyone driving on it. Most decentralized exchanges today make you choose between transparency and speed. They give you custody of your assets, but you deal with clunky delays, high gas fees, or confusing order books. Hyperliquid is trying to erase that trade-off. It wants the experience to feel as quick as a top-tier centralized exchange, while staying fully decentralized and verifiable on-chain. The way it pulls this off is through its custom consensus system, HyperBFT. Think of it as a group of validators who reach agreement very quickly, so when you send an order, it's finalized in under a second. There's no hanging in limbo wondering if it went through. Another big shift is the fully on-chain order book. Normally, most decentralized exchanges run order books off-chain and only post the final transaction on-chain. Hyperliquid records every single action, every order, every cancellation, every fill, directly on the blockchain. That means nothing is hidden. It's all transparent, and you can audit it yourself. On top of that, they've removed gas fees from trading. Imagine never having to confirm another gas pop-up just to move your position or set a stop. That makes the platform feel smooth and familiar, especially for traders coming from centralized exchanges. And they've designed the system to handle huge volumes, hundreds of thousands of orders per second today, with the potential to scale into the millions. In practice, it means the network can stay fast even when markets get wild. So what can you actually do on it? You can trade perps and spot pairs with tools you'd expect. Market and limit orders, stop law, take profit, TWAP, scale orders, up to 50x leverage on supported markets. There's copy trading through vaults where you can seed strategies or follow others transparently. And because Hyperliquid has its own EVM environment, developers can build apps directly on top of the chain that plug into the same order books and balances. It's not just an exchange. It's a foundation for new trading tools. Funding the account is straightforward. You bridge USDC from Arbitrum or other networks, connect your wallet, and you're in. Withdrawals are protected by validators who sign and confirm before assets are released, keeping the process secure but still efficient. The people behind it come from strong technical backgrounds: Harvard, Caltech, MIT, and high-performance trading firms. And what stands out is that Hyperliquid is entirely self-funded. There are no venture capital strings attached, no external investors calling the shots. That independence shows in how they've focused on building features that matter to real traders, and in how they've distributed tokens in a community-first way. In the end, what makes Hyperliquid stand out is the mix of speed you can actually feel, costs that don't nickel and dime you, transparency baked into the system, and tools built for both everyday traders and power users. It's an ambitious vision, but it comes with the risks all new chains carry: software bugs, market stress, and the ongoing challenge of keeping liquidity deep. The team runs audits, they harden the system, but there's no such thing as risk-free in DeFi. The bottom line is this: Hyperliquid is trying to be the place where on-chain trading finally feels fast, fair, and fully transparent. Not just DeFi-inspired, but truly on-chain without the usual compromises. So how does Hyperliquid keep everything running so fast without falling apart? At the heart of it is their custom-built consensus system called HyperBFT. If consensus sounds abstract, think of it like referees in a game. Their job is to make sure every play is recorded correctly and no one cheats. On most blockchains, the referees take their time, blowing whistles, checking replays, delaying the game. Hyperliquid's referees move in real time. They've rebuilt the rules so that transactions reach finality almost instantly, under 1 second. For traders, that means when you place an order, you don't sit around refreshing the screen or worrying about lag. It's just done. The chain itself is divided into two big parts. First is Hypercore, which runs the trading engine. This is where perpetual futures and spot markets live. Every order, cancellation, liquidation, or trade happens on-chain with one block finality. No shortcuts, no off-chain processing, no hidden deals. It's like having the entire exchange visible in the open, where every move is transparent. The second part is HyperEVM, which is an Ethereum-compatible environment. That means developers can build apps, tools, and contracts that feel just like they do on Ethereum, but plugged directly into Hyperliquid's high-performance core. Imagine decentralized apps that can tap into a trading engine handling hundreds of thousands of orders per second. That's the power of combining Hypercore and HyperEVM. And then there's the bridge. Normally, moving assets across chains is clunky and risky. Hyperliquid designed its own bridge system tied directly to its validators. To deposit, you move stablecoins like USDC from Arbitrum to Hyperliquid, and the validators sign off. To withdraw, validators must also approve with a 2/3 majority before anything leaves. That way, no single actor can sneak funds out. It's a balance between speed and safety. The system has been tested to handle around 200,000 orders per second already, with optimization paths to scale into millions. Latency, or the time it takes for your action to confirm, averages about 0.2 seconds. That's faster than you can blink. Even under stress, it stays below 1 second, which makes it competitive with centralized exchanges. But it's not only about raw speed. Hyperliquid also built in strong security practices. Smart contracts are audited, validators share responsibility for approving critical moves, and the protocol resists manipulation attempts. For example, oracles, the feeds that tell smart contracts what's happening in the real world, are updated by validators every few seconds to keep data accurate. That protects against pricing games or sudden gaps. The philosophy here is simple. Everything happens on-chain, nothing is hidden, and speed doesn't come at the cost of trust. It's still decentralized, but built with the performance of a professional trading venue. For most people, trading crypto on a decentralized exchange feels like a compromise. You either get speed but give up transparency, or you get transparency but suffer through lag, slippage, and clunky execution. Hyperliquid is trying to erase that trade-off. On Hyperliquid, perpetual futures are the main stage. These are contracts that let you speculate on the price of Bitcoin, Ethereum, Solana, or even Netch tokens without owning them directly. Traders can take positions with leverage up to 50x in some cases, meaning small moves can lead to outsized gains or losses. But unlike centralized exchanges that hold your funds and decide when trades settle, everything here is on-chain. Every order, every liquidation, every funding update is visible to anyone who cares to check. The trading process itself is surprisingly smooth. Orders hit the chain in under a second, so it feels almost instant. There are no gas fees for these trades, which is rare in DeFi. That means whether you're trading $10 or $10,000, the transaction cost isn't eating into your margin. For high-frequency traders, this is huge. It opens the door to automated strategies that were never viable on slower or more expensive blockchains. What really stands out is the order book. Most decentralized platforms rely on automated market makers, pools of liquidity that adjust prices based on supply and demand. Hyperliquid does it differently. It keeps a fully on-chain order book, just like a traditional exchange. Buyers and sellers post bids and offers, and the engine matches them directly. This means tighter spreads, less slippage, and a clearer picture of market depth. It's something traders have long wanted but rarely seen executed properly in DeFi. And it's not just basic trading. Hyperliquid layers and features you'd expect from professional venues. Copy trading vaults where you can mirror strategies, advanced order types like scale orders and TWAP, and risk management tools that help protect against wild market swings. For experienced traders, it feels like a centralized exchange. For new users, the interface is clean and intuitive enough not to overwhelm. Even bridging into the platform is designed with simplicity. If you're holding USDC on Ethereum, Arbitrum, or other supported chains, you can move it onto Hyperliquid through its validator-backed bridge. Within minutes, you're ready to trade. Withdrawals work in the same way, requiring majority validator approval before funds leave, which adds an extra layer of security. The combination of low fees, speed, and transparency makes Hyperliquid stand out in a crowded space. It isn't just chasing hype with buzzwords. Instead, it's trying to create the kind of trading environment people actually want. One that's fast, fair, and doesn't ask you to sacrifice trust for convenience. At the center of Hyperliquid's ecosystem is its native token, Hype. Now, plenty of platforms have a token, but the way Hyperliquid treats Hype is different. It isn't just a ticket for speculation, it's the backbone of governance, security, and incentives across the network. Think of Hype as three things rolled into one. First, it's a governance token. Holders get to vote on important decisions like which assets are listed, how fees are structured, or what upgrades roll out next. Instead of a small group of insiders pulling the strings, the people actually using the platform have a say in how it evolves. That's powerful in a market where so many exchanges still operate as black boxes. Second, Hype is a staking token. By staking, users commit their tokens to validators who secure the Hyperliquid network. In return, they earn rewards. This isn't just passive income. It's what keeps the chain decentralized and resistant to attacks. The more tokens staked, the harder it becomes for any bad actor to disrupt the system. And third, Hype has a deflationary model. Unlike inflationary tokens that print more supply over time and dilute holders, Hyperliquid is burning around 26% of Hype annually. That's a huge reduction. Scarcity paired with actual utility gives the token long-term weight. It's not just another chip in the casino. It's designed to grow in value as the platform itself expands. The distribution of Hype also tells a story. When the airdrop happened in late 2024, it wasn't the usual VC-heavy affair. No private investor sitting on massive allocations waiting to dump. Instead, over 70% of the supply was earmarked for the community, through the airdrop, ongoing rewards, and emissions to keep people engaged. Even the team behind Hyperliquid locked their own allocations for a year after launch, signaling they were in it for the long game. The airdrop itself was one of the most generous in crypto history. Early users reported allocations worth tens of thousands of dollars, sometimes more. Unlike other projects where tokens flood the market and crash after distribution, Hype actually surged in value post-airdrop, a sign of genuine demand meeting well-planned supply. Beyond governance and staking, Hype also lowers trading costs. Traders who use it for fees get discounts, making it practical as well as symbolic. And because Hyperliquid is aiming to become a complete financial ecosystem, not just an exchange, Hype is expected to play a role in funding new features, integrations, and community-driven proposals. All of this paints a picture of a token that's integral, not optional. In crypto, tokens often live or die by narrative. Hype's narrative is tied to real utility, securing the chain, steering its direction, rewarding participation, and shrinking supply. It's not a token you forget about once you've cashed in your airdrop. It's the lifeblood of the system. Every project, no matter how impressive, carries its shadows. Hyperliquid is no different. For all its speed, innovation, and community-first design, There are risks that traders and investors need to keep in mind. The first is technology risk. Hyperliquid is still a relatively young Layer 1 blockchain. It's built for speed and transparency, yes, but new blockchains often face unexpected hurdles. Bugs, performance bottlenecks, or unforeseen exploits can test even the most carefully designed systems. The team has built Hyperliquid with audits and optimizations, but no system is ever bulletproof in the long run. Then there's counterparty exposure. Hyperliquid reduces the reliance on intermediaries, which is a good thing, but traders are still exposed to each other's actions. In extreme volatility, a sudden liquidation cascade can ripple through the system. The automated mechanisms are there to prevent collapse, but crypto history shows us that stress tests often reveal cracks no one saw coming. Liquidity risk is another factor. Hyperliquid prides itself on deep on-chain liquidity, but in fast-moving markets, even deep pools can thin out. When liquidity dries up, traders may face higher slippage or slower order execution. This is especially risky for leveraged traders, where a small price swing can mean massive losses. Market volatility itself is unavoidable. Crypto prices are infamous for sharp swings, and while Hyperliquid offers tools to manage risk, like stop losses and liquidation protections, no platform can eliminate volatility. With up to 50x leverage available, the stakes are even higher for those who push the limits. Smart contract vulnerabilities also loom in the background. Hyperliquid's contracts have been audited, but audits are not guarantees. Complex systems can hide flaws, and attackers are constantly looking for openings. One exploit could undermine confidence even if it doesn't wipe out the platform. And then there's regulation. Hyperliquid sits in the world of perpetual futures trading, a space that regulators are paying more and more attention to. The platform has already engaged with U.S. regulators, signaling it wants to be proactive. But the global landscape is shifting, and new rules could affect how or where Hyperliquid operates. Compliance might bring legitimacy, but it could also introduce restrictions that clash with its decentralized ethos. Finally, governance itself poses challenges. While community-driven governance is powerful, it depends on participation. If only a small fraction of token holders vote, decisions may not reflect the wider community's interest. And if governance falls into the hands of a few large players, it risks recreating the same centralization the project set out to avoid. So yes, Hyperliquid has immense potential. But it's important to see it clearly, not just as hype. Every advantage comes with its own risk. Speed can mean complexity, openness can invite bad actors, and decentralization can still slip into concentration. So what does Hyperliquid really mean for the future of trading? At its heart, it's more than just another decentralized exchange. It's proof that DeFi doesn't have to be slow, clunky, or hidden behind the complex mechanics. It shows that speed, transparency, and trust can all live in the same place. Think about it. An order book that's fully on-chain, not halfway centralized. A system where trades finalize in under a second, giving you confidence in every move. Bridges that make it easy to bring your assets in no matter what chain you're on. And a token model designed with scarcity, governance, and community in mind, not just to feed investors. But beyond the technical pieces, Hyperliquid represents something bigger, a shift in how we imagine finance itself. For decades, the trading world has been locked behind walls built by institutions. Access was controlled, rules were rigid, and opportunities were uneven. Platforms like Hyperliquid tear down those walls, replacing them with rails anyone can use. It's not just about trading crypto, it's about building a foundation where anyone, anywhere can participate in open markets without permission. Of course, no project is without risks. Hyperliquid will face challenges, from volatility and liquidity crunches to regulatory uncertainty and competition from giants like dYdX and GMX. But the way it has positioned itself, with innovation at its core and community at its center, gives it a real shot at lasting impact. In the end, Hyperliquid is trying to do what few have dared: create a decentralized exchange that feels as smooth and powerful as the platform's traders already know, but without the compromises. If it succeeds, it won't just change how we trade. It could redefine what we expect from finance in the first place. And maybe that's the real story here. Hyperliquid isn't just about faster trades or new features. It's about proving that decentralized systems can rise to the level of traditional finance, and maybe someday surpass it.